Hi there. My name is Pete Harriman. I'm a certified business advisor with the Maine Small Business Development Center. Hopefully you watched the first video that I did, which talked about the LLC, sole proprietor, and partnership, and just a general idea of how it would look like for taxes and why we recommend the 25 to 30% set aside for people to estimate their taxes on the profit. Now we're going to talk about a corporation, right? So first off, we're going to talk about the liability of a corporation, then go through the taxes, just like we did with the sole proprietor and the partnership and the LLC. So when we're talking a corporation, we are talking actually creating a person in the eyes of the law. So with the sole proprietor, you and the business were one. With an LLC, you split yourself into two, but it was still you. With a corporation, it eliminates you entirely. What we're doing is we're creating a person in the eyes of the law, and that person then hires you as an employee, right? You might be the only employee, you might be the CEO, who knows? But that person is now who owns the business. It's important because from a liability standpoint, if your business gets sued as a corporation, it's that person getting sued. And you are an employee that just works there. If there's criminality involved, there might be some negligence. But when we're talking about a C corporation, it has an entirely separate tax form, right? So we got some good liability protection. C Corp is like the gold standard for liability. We got the silver for the LLC and the bronze for the sole proprietor and the partnership. So the corporation has great liability protection. But this tax form is a whole separate form. It's as if you were filing a separate tax form for a separate person because you are. The C Corp, for all intents and purposes, is a separate person in the eyes of the law. So it's going to have an 1120 tax form. In this 1120 tax form, it kind of does the same thing that this tax form does. It's going to ask you about the sales. It's going to ask you about your business expenses because it wants to get to the same answer. What is the taxable profit of the corporation? Right? So if we use this number, we're just going to assume that everything worked the same as it did over here so we can use the same number. So we're going to grab this 50,000. We're going to pull it. We're going to put it over here. So if we start with the 50,000, you are now an employee of this person. So you now have to recognize your salary, right? So my salary, let's say I want $40,000 as salary. So salary in this case is an expense of the business because your salary is going to have a W-2 attached to it, right? So you're going to pay taxes on that salary through a W-2. This $10,000 now becomes the profit of the business. Now, with the business, you can either invest it in the business itself and you don't pay any taxes, or more likely, you're going to want to take it out as a dividend, right? Now, when you take it out of the business, which you probably want to do, there's also taxes that we deal with, right? And this is where we get into the double taxation. Remember that person you created as a business, right? That's my business. That person gets taxed and you get taxed, right? So that person gets taxed with corporate tax. Right? And with the tax law, this went significantly down, right? It used to be 38%, it went down to 21%. The second way you get taxed is the same as over here, income taxes. Okay, so if we have state and federal, we use the same rate over here. We assume the same so we can compare apples to apples. So If we add these together, like we did over here, the 21 and the down here, we have 31 to 36%. In general, remember this does depend on where your income tax bracket stands. So the 31 to 36% is a little higher, right? Remember, it's not on all of it. It's only on that 10,000 because the other 40,000 is your salary. It's going to have the same taxes as Social Security and Medicare. But on this 10,000, you're going to pay a little bit more for that added protection. And what that is your liability protection. Your person is paying taxes, and then you're paying taxes, right? So there's a double taxation here. And that's what a lot of people don't like. Great liability protection with a corporation, a little higher taxes. So you end up paying for it. So usually when I see corporations, it's when businesses get to the larger scale or there's a lot of risk in the business and they don't want to take, they want the best protection, they don't want to take as much risk. But as I said, here you will have a salary that is an expense of the business. Over here, your salary is part of the profits of the business, right? So you don't expense your salary. You as a business owner in this example, whatever's left over is your pay. That's why you're being charged Social Security and Medicare for all that's left over. Over here, your salary is your pay. That's why Social Security and Medicare are going to be taken out just like as if you were any other W-2 worker. The important thing to note is if you are someone that really cares about putting the maximum amount aside into Social Security and Medicare, this $10,000 here, the dividend, that does not have Social Security and Medicare taken out of it. So that does not count towards your payments. So something to think about. But again, here, you're going to pay a slightly higher rate, 31 to 36%, versus over here, which is 25 to 30%. So the next video, we're going to really focus on both of these having a baby called the S Corp, right? The S Corp is a little bit of this and a little bit of that. And hopefully I have enough room right here to kind of squeeze it in, right? So watch the next video, number 3 of 3, to get the answer on S Corp.